Okay, so you want to own a gym. You walk in on a Tuesday at 6 p.m., and every treadmill has a body on it. The squat racks are booked. Someone's waiting by the door for a locker to free up. You stand there and do the obvious math in your head. Hundreds of people, all paying monthly, all funneling cash into one building. It looks like the closest thing to a money machine that regular people can actually buy into. Here's the problem. You just watched the 1 hour of the week that gym owners themselves describe as the least representative hour there is. Walk back in on a random Tuesday at 11 a.m., and you'll find 3 people and a mop bucket. The real business isn't happening on the floor at all. Underneath the equipment and the mirrors, a gym is a cash flow machine that sells promises people mostly don't keep. And the moment you understand that, every number in this business starts to make a different kind of sense. Let's start with what it costs just to unlock the front door, because almost nobody researching this walks in with the right number in their head. The first myth to kill is that gyms are one business. They're not. They're 4 or 5 different businesses stapled to the same word. On the low end, you've got high volume budget clubs, the $10 to $30 a month operators that pack a warehouse-sized space with several thousand members and run it with a handful of staff. One step up is the mid-market commercial gym. Weights, cardio, a class schedule, usually landing somewhere between $35 and $65 a month. Above that sit the premium and boutique operators, specialty class formats, or full-service athletic clubs, charging anywhere from $60 to well over $200 a month, selling atmosphere as much as equipment. And at the very small end, there's the private coaching studio, sometimes a few hundred square feet, that doesn't sell floor access at all. It sells a trainer's calendar. Each of those is really a different wager on the same question. A lot of people paying a little, or a few people paying a lot. Now here's where people underestimate the entry price. And it isn't the dumbbells. It's converting an empty commercial shell into a space that's legally allowed to hold sweating bodies. Most commercial landlords want 2 to 4 months of rent locked up front as a deposit before you've touched a wall. Then the build-out starts. Impact-rated rubber flooring that can take a dropped barbell without cracking the slab underneath typically runs somewhere in the $10,000 to $35,000 range, depending on square footage. Locker rooms and showers need moisture-sealed materials and dedicated drainage, and that's usually another $15,000 to $45,000. Mirrored walls alone can add another $3,000 to $10,000 once they're professionally mounted. Then there's the cost almost nobody prices correctly going in: air handling. A retail shell isn't built to move the volume of fresh air a room full of exercising bodies needs for hours at a stretch. Most local codes tie required ventilation to occupancy and square footage, not a flat number. And once you run that calculation for a mid-size floor at peak capacity, you're often looking at a full commercial HVAC upgrade priced anywhere from $15,000 to $60,000, sometimes more, before a single membership card gets swiped. Stack the deposit, the build-out, licensing and permitting, liability insurance, an opening marketing push, and a cash cushion to survive the slow first stretch, and a modest mid-size independent gym can realistically require somewhere between $350,000 and just over $1 million before it earns a single dollar back. That's the real cost of entry. And it's before you've bought a single treadmill. Speaking of which, equipment is its own trap. A commercial-grade treadmill typically runs $3,000 to $7,000, and a baseline cardio section wants at least 8 to 15 of them. Plate-loaded and selectorized strength machines run roughly $1,500 to $4,000 apiece, and a real strength floor needs 15 to 25 of them. Add racks, benches, free weights, and accessories, and total equipment spend for a mid-sized gym commonly lands somewhere between $50,000 and $200,000. And now you're facing the decision that quietly determines your first 3 years. Buy the equipment outright or lease it. Buying means it's yours, no recurring bill. But it also drains the exact cash reserve you need most in those uncertain early months before membership ramps. Leasing keeps monthly payments small and lets you refresh equipment every few years. Which sounds like the obvious answer. Here's the catch. Equipment lease financing commonly carries effective interest in the high single digits to low double digits annually. So over the life of the agreement, you typically pay noticeably more than the gear was worth. And the lease doesn't care whether your membership numbers hit target. It's a fixed obligation, regardless of how many people walk through the door that month. Then there's location, and this is where first-time owners get the math wrong in a very specific way. They think busy area is the whole analysis. It isn't. Industry data on gym trade areas consistently shows the overwhelming majority of a location's membership base lives or works within roughly a 10 to 15-minute drive of the building. That's your entire addressable market, not the city. Inside that radius, the income profile of the neighborhood has to actually match your price point, because a premium club charging $150 a month cannot survive long-term in a trade area built around budget income levels, regardless of how nice the equipment looks. And commercial rent itself swings wildly with location, from roughly $10 to $20 per square foot annually in a low-density suburban strip, up to well over $100 per square foot in a dense urban storefront. Pick the wrong side of that gap, and you've locked yourself into a rent bill your actual trade area membership pool can't cover. There's also a structural fork almost every first-time buyer faces before any of that. Build independent or buy into a franchise. A franchise hands you a recognized name, a tested layout, standardized software, and often better pricing on equipment through the parent company's purchasing scale. Genuinely valuable if you've never run a facility before, but it isn't free. Franchise agreements commonly require an upfront franchise fee somewhere in the $25,000 to $60,000 range, an ongoing royalty, typically running 5 to 8% of gross revenue paid back every month, and often an additional 1 to 2% of revenue funneled into a shared national marketing fund. An independent owner keeps every dollar the location generates. A franchise owner is permanently handing back a slice of the top line, forever, in exchange for brand pull and operational support, which only pencils out if that brand recognition genuinely drives enough extra membership volume to cover what you're sending back every single month. So now let's get to how a gym actually makes money, because this is where the real engine of the business hides in plain sight. Think of a membership sale as a fork in the road with two very different outcomes. One version of that new member shows up 3 or 4 times a week for the next year. The other version shows up twice in the first month, feels good about the decision, and then quietly never returns, while the card on file keeps getting billed every 30 days. Here's the question worth sitting with for a second. Which of those two customers is actually more valuable to the gym? It's the second one. And once that clicks, the entire revenue model reorganizes itself in your head. Revenue stream 1 is the base membership itself, and its real mechanic isn't attendance, it's non-attendance. The person who trains hard 4 times a week, uses hot water, wears down equipment, needs towel service, and occupies floor space during exactly the hour the gym is most crowded, which can push other paying members toward frustration and eventual cancellation. Every visit costs the business real water, real electricity, real wear, real laundering. The member who signed up and stopped showing costs almost nothing to serve, no hot water, no equipment wear, no crowding, while their monthly draft keeps landing like clockwork. Multiple industry surveys on gym attendance patterns put the share of members who rarely or never use their membership at somewhere around 60 to 70%. Read that back. A large majority of a typical low-cost gym's revenue is coming from people who effectively aren't using the building. That's not a flaw in the model, it's the model. Revenue stream 2 is personal and small group coaching, and its counterintuitive insight is about the ceiling, not the floor. A trainer working purely one-on-one, charging roughly $75 to $90 a session, and capped at a realistic 20 to 25 sessions a week across a working year, tops out around $90,000 to $110,000 in annual billing. That's a hard wall. There are only so many hours in a day. The way past that wall is training multiple clients at once. A coach running a small group session with 4 people, each paying $35 to $40, brings in close to $150 for that single hour, roughly double the one-on-one rate, while each individual client actually pays less than private coaching would cost. That's why so many gyms have leaned hard into small group formats over the past decade, because it breaks the one trainer, 1 hour ceiling that caps pure personal training. The gym typically keeps a share too, since trainers on payroll commonly earn a commission of somewhere around 35 to 50% of what they bill, meaning the facility retains the rest to cover space, equipment, and overhead. Revenue stream 3 is ancillary retail and services, supplements, apparel, tanning or recovery add-ons, childcare fees, guest passes. Individually, each of these looks small, a few $1,000s a month at most for a mid-sized location. But the counterintuitive part is margin, not volume. Retail and add-on services typically carry gross margins in the 50 to 70% range, dramatically higher than the margin on the core membership dues once you've accounted for the fixed cost of running the facility. A gym that treats retail as an afterthought is leaving some of its highest margin dollars on the table. Revenue stream 4, if the gym runs one, is corporate and group partnerships, discounted bulk memberships sold to local employers, or insurance wellness programs. The mechanism looks like a discount, and it is one. Individual rates typically run 20 to 40% below retail. But the insight is volume with near zero acquisition cost. A single signed employer contract can deliver dozens of new members without $1 of individual marketing spend. And because it's a batch enrollment, it also front loads the same non-attendance economics from Stream 1 across a much larger group all at once. There's a fifth stream worth naming too, even though it's smaller and often overlooked: enrollment and processing fees. A one-time joining fee, often anywhere from $25 to $100, plus a small monthly account servicing or facility fee layered on top of dues. Both look like a minor add-on. The counterintuitive part is that this fee income is almost pure margin from day one. There's no marginal service cost tied to it at all. Unlike dues income, which is theoretically supposed to fund actual facility use, owners who waive these fees aggressively to win signups during promotional pushes are often trading away some of the highest margin dollars available in the entire business just to boost a headline enrollment number. There's a psychology layer underneath all of this too, worth understanding because it's not accidental. Why do people keep paying for something they barely use? Part of it is optimism. At the exact moment of signing, the membership feels like a promise made to a future, more disciplined version of yourself. Part of it is what behavioral economists call a commitment device. The idea that paying up front is supposed to be the thing that forces you to actually go. And part of it is plain inertia. Canceling means admitting the plan stalled. And for a routine monthly charge of $10 to $40, most people would rather keep quietly paying than confront that. Facility design leans into this whether members consciously notice it or not. Open, uncluttered layouts with obvious sightlines reduce the intimidation a first-time visitor feels, which keeps them coming back long enough for a habit to either take hold or fade out naturally. Strength areas are often lit with harder, more directional lighting that makes muscle definition more visible and keeps energy high, while stretching and recovery corners typically use softer, warmer lighting to feel calmer. Even the tempo of the background music is a deliberate choice, since research on exercise performance has repeatedly linked faster tempo music to lower perceived effort during a workout. None of it is decoration. All of it is aimed at the same target: keeping someone emotionally attached to the gym for as long as possible, whether or not they're actually using it that week. Now for what nobody tells first-time owners: the hidden bleed that separates the number on the whiteboard from the number that actually lands in the owner's account. Staffing is the first and largest piece almost everyone underestimates. Front desk coverage, cleaning staff, maintenance, management, and coaching payroll for a mid-sized gym commonly runs somewhere between $40,000 and $100,000 a month. Once you include payroll taxes and basic benefits, and unlike a corporate office, a gym needs live coverage during early mornings, evenings, and weekends specifically, because that's when the crowded, high-cost hour of usage happens. Churn is the second piece, and it's brutal in a way spreadsheets don't capture well. Industry benchmarks on annual member churn for the fitness industry commonly sit in the 30 to 40% range. If a location has 600 members and loses roughly 5% a month, it has to bring in somewhere around 240 new members over the course of a year just to stay flat. That's not growth. That's treading water. And every one of those replacement signups costs real marketing dollars to acquire. Seasonality is the third piece. A meaningful share of annual signups, commonly cited at around 10 to 15% of the entire year's new memberships, lands in the single month of January, driven by resolution season. Gyms lean into it hard: discounted enrollment fees, trial pricing, a concentrated ad push. But the same wave that arrives fast tends to leave almost as fast. Studies on resolution-driven gym members consistently show a large share, often cited above 70%, have stopped attending by the time summer arrives, with February typically marked as the highest risk cancellation month, as initial motivation fades before a habit forms. Owners who spend that January windfall as if it's a permanent baseline, rather than a seasonal spike to bank against the slower months, are the ones who run into a cash crunch in the summer. Legal and licensing exposure is the fourth piece, and it's the one that catches people completely off guard because it has nothing to do with equipment. Playing background music in a commercial space legally requires a public performance license, and there isn't one single license to buy. There are several performing rights organizations, each representing a different pool of songwriters and publishers, and a gym typically needs coverage from more than one simultaneously. Combined annual licensing fees for a single location commonly land somewhere between $1,000 and $4,000 a year. Skip it, and the exposure isn't small. Federal copyright law allows statutory damages for willful infringement that can run from several $100s up to tens of thousands of dollars per song, and licensing organizations do send field investigators specifically to check commercial locations. A gym owner who assumes a personal music subscription covers the sound system has taken on a legal risk worth vastly more than the license would have cost. And then there's the friction built into the exit, because gyms have historically made canceling meaningfully harder than joining. Many contracts have required cancellation in writing or in person, rather than through an app, often with 30 to 60 days of advance notice, which guarantees at least one more build cycle even after a member has decided to leave. Regulators have started pushing back. The Federal Trade Commission attempted to introduce a nationwide click-to-cancel rule, requiring subscriptions to be as easy to cancel as they are to join. A federal appeals court struck that specific rule down on procedural grounds in 2025, and the agency has since restarted the rulemaking process. Some jurisdictions have moved independently in the meantime, with their own local cancellation friction rules and financial penalties for gyms that don't comply. The fact that cancellation friction became such a deliberate part of gym operations across the industry tells you something important. If the business depended entirely on happy, actively attending members, it wouldn't need to make leaving this hard. One more piece of the hidden bleed rarely gets budgeted correctly. Ongoing maintenance and utilities. The slow drip rather than the dramatic expense. Heavy daily use wears down treadmill belts, cables, and upholstery far faster than any home gym ever would. And mid-sized facilities commonly set aside somewhere between $1,000 and $3,000 a month just for equipment repair and replacement to keep the floor looking presentable. Utility costs for space running, constant ventilation, bright lighting, and hot water for showers typically land somewhere between $1,000 and $6,000 a month, depending on climate and building size. None of these figures look dramatic sitting alone on a spreadsheet line. Stacked together month after month, they quietly erode exactly the margin an owner projected on day one. There's also a break-even math worth spelling out plainly, because it clarifies why the non-attendance economics from earlier matter so much. If a location carries roughly $35,000 a month in fixed costs, rent, payroll, debt service, utilities, software, insurance, and charges an average of around $85 a month per member, it needs somewhere around 412 paying members just to break even. Below that line, the location loses money every single month. Above it, additional members are close to pure profit, because the marginal cost of serving an inactive member is nearly zero. New locations rarely hit that break-even count on opening day. Industry benchmarks commonly cite 12 to 18 months before a new facility crosses into sustained profitability, and every one of those months draws down the cash reserve set aside before opening. If pre-launch sales run soft, or a competitor opens nearby during that exact runway, the reserve can run dry before the location ever turns a genuine profit. Now, does this business model actually hold up under real-world pressure? Sometimes, and sometimes spectacularly not. Consider Lifetime Fitness. In the mid-2010s, Lifetime was a large, well-known athletic club operator, but it was carrying real questions about how sustainable its growth-heavy, real estate-intensive model actually was, and in 2015, it went private in a leveraged buyout worth roughly $4 billion, taken on by private equity investors, betting they could restructure the business away from public market scrutiny. Here's the suspense worth sitting in for a second. Taking a fitness company private in a heavily leveraged deal, loading it with new debt, right before an entire industry got hit by a once-in-a-century shock to in-person attendance. Sounds like exactly the kind of setup that sank other major chains. So how did Lifetime not just survive that stretch, but come out of it stronger? The answer runs directly through the mechanics already laid out here. Lifetime had leaned deliberately into the premium end of the market, rather than the volume end, charging materially higher dues for a differentiated experience, which meant its member base skewed toward people less sensitive to price during a downturn. It had also invested heavily in owning, rather than purely leasing, many of its real estate assets, which changed its fixed cost exposure compared to chains renting every location. And it diversified hard into ancillary revenue streams, health services, hospitality-style amenities, corporate wellness partnerships, exactly the kind of high-margin add-ons described earlier. When the pandemic hit in 2020, Lifetime temporarily closed locations and saw real financial strain, including furloughs and a public capital raise to shore up liquidity, but the underlying business model held together well enough that the company returned to the public markets through an IPO in October 2021 and has since continued expanding its footprint. That's not a story about a gym surviving because people loved working out. It's a story about a gym surviving because its ownership structure, its price positioning, and its revenue diversification were built to absorb exactly the kind of shock that has sunk plenty of other operators in this same industry. Compare that to what typically happens when a chain leans the opposite way: thin margins, heavy reliance on volume-priced memberships, and locations financed almost entirely through leased real estate and leased equipment rather than owned assets. When a shock hits attendance or cash flow in that structure, there's no ownership cushion to absorb it and no premium pricing buffer to fall back on. The fixed lease and debt obligations keep coming due on the same schedule, regardless of what's happening on the gym floor. Lifetime's advantage wasn't luck or a better logo. It was that the underlying financial architecture matched the risk of the business it was actually in. So let's put the actual numbers side by side, because this is where the two very different versions of gym ownership reveal themselves. In the optimistic scenario, you picked a trade area where your price point genuinely fits the local income level. You hit your break-even membership count roughly on schedule, you kept churn on the lower end of the industry range, and you built a real coaching and retail program alongside the base membership. Under those conditions, a mid-size independent gym can realistically generate somewhere between $600,000 and $1.5 million a year in revenue, with a net profit margin commonly cited in the 12 to 20% range. That can put an owner's annual take-home somewhere between $80,000 and $200,000. A genuinely solid return for the capital and hours involved. In the realistic scenario, nothing catastrophic happens. That's the important part. Churn drifts to the high end of the normal range, instead of the low end. A new budget competitor opens a couple of miles away and pulls your most price-sensitive members onto a cheaper monthly rate. Equipment starts needing repairs more often than the original plan assumed, adding another $1,000 to $3,000 a month in overhead. None of that shows up as a headline. The parking lot still looks reasonably full most evenings, but that same gym can slide from a comfortable double-digit margin into a thin single-digit margin, or into an outright loss during the slower summer stretch, and the swing between those two outcomes in a single year can easily exceed $100,000 for a mid-sized location, with almost none of it visible from the sidewalk. So if you're seriously weighing whether to buy or open a gym, hold on to this. The number of people who sign up was never really the thing that determines whether you succeed. It's how well the business survives on the people who stop showing up. And once you understand a gym's real business model runs on unused memberships and quiet non-attendance, it raises an obvious next question worth its own deep dive: whether that exact same subscription economics playbook holds up just as well, or breaks down completely, in a very different kind of recurring revenue business. If this kind of breakdown is useful, drop a comment with the business you'd want us to pull apart next. And if you want more of these, subscribing means you won't miss the next one.